Okay, starting the stream. You go into the bathroom. Okay, I'll give you a minute. Okay, so we're going to go through a little bit of stuff on filtering SMTs with discount prices. We'll be using opening prices for that, and we'll also tie it into dealing ranges. But first, I'm going to cover this London trade that we did in the morning because I got a request for that. So it wasn't silver bullet, but I will go through the London silver bullet first. Really simple. Takes out the intermediate term high, breaks down lower. This low is a breaker block, so we have a low, high, lower low, higher high. That makes the market structure shift the breaker. When you go through that, you want to see user support. What if you were looking for an earlier entry? Well, you could have used this, a market structure shift. That would have worked fine. Your entry would have been a little bit sloppy because if you entered on the fair value gap, it would have traded all the way back up. So a bit less ideal. The best entries are going to come from the breaker block. This is where you'll get the most precision and the least drawdown in your entries. So we trade back into the market structure shift being the breaker block. Then we get this huge run lower, which is the low of Asia, and then the low of yesterday's in your game. Have you made a video or covered about standard deviations anyway? Yes, I have. It's literally titled on my YouTube channel, How to Use Standard Deviations, and that's me going through fulcrums, so yeah, you can go through that. Okay, regarding the London trade, I used implied ranges, done a video on grading implied dealing ranges, and then using that for trade entries. I'm going to delete this and draw it back on. So for an implied dealing range, you're going from the impulse of the price swing that you're looking at. So it could be this low, you could use that low, but I'm using this one to further refine it. Actually, wrong already. From there, and then I'm drawing it into my terminus point. So that would be either this high, these relatively equal highs, whatever you're individually looking at, that's fine. Let's say you're looking at these relatively equal highs. At the 50% level, or equilibrium, I'll zoom in. Around this area, doesn't matter, like, you don't need to be super precise, you just literally draw a box. You're more likely to get consolidation at 50% of any range, a fair value gap range, a liquidity void, a vacuum block, an implied dealing range. You're way more likely to get consolidation at the equilibrium of those levels. So here we have consolidation. My entry was there. Why did I not wait for it to sweep the low like I taught in the swing grading lecture? Because I didn't have time. It's that simple. And I was expecting it to drop down below. I had my stop there. So I entered. I came back later on, and then I saw we were in a nice consolidation. Then we dropped down below this consolidation low. This one. This one rather. We sweep that. We also trade into bullish order blocks and this tiny little inefficiency. And this is trade opportunity number 3. So in the swing grading lecture where I gave you all those trading opportunities, the third one is when you trade up into the upper quarter or the upper quadrant of the implied range, and then you drop down either past the original consolidation, not the original consolidation, the equilibrium consolidation, or you drop down into an order block. And the way you judge which one it's going to do is by looking at the speed and displacement of price action. So when we took this low out and then we started trailing this wick back up, that's when I was able to have more confidence in taking a buy there. I wasn't looking at SMT, I wasn't looking at other assets or the dollar. It was just literally the swing grading stuff I taught. And then if we look at yesterday's PM session, and you use that for your implied range because say your terminus point is up there now, this becomes equilibrium. And this is, again, trade opportunity number 3. Number 2. It trades above consolidation, then it returns back into it. It doesn't need to take out the entire equilibrium, but what it does is it uses an order block from the equilibrium consolidation, and then it trades higher again. So that's the explanation of the trade. How do you determine that implied range? Again, you go from the impulse of the price swing. So you could use this, you could use this, you could further refine it to there, but really you want to account for where's it going to move to, and then you want to pick the impulse price swing. So if you were looking at the London session, you would use these relatively equal highs or the spool point, but I was looking a little bit high time frame and I was using that. Why do I have the confidence that it could potentially trade back into the New York PM high from yesterday, even though it's outside of the London session? Because of the speed and magnitude that London was having, and then when we trade back above that and we get this reversal pattern with speed and displacement, then we consolidate and we trade below the consolidation. That allowed me to place the next entry with more confidence in it going into the New York PM high yesterday because of the speed prices moving it. Really simple. And it took out both sides of the Asian range, which is less than was the less common situation. And usually it means your London session is going to be really fast. Sometimes you'll get a really large Asian session, and then London will be working within the Asian range. But when you have a small range, it leads to a large range. And then a small range, it leads to a large range. As we've been teaching. Okay, I'm going to take those off now, and then we'll look at pools of liquidity. And then we'll get into SMT in a bit. And also for your study, because I kind of wanted to explain it now. If you look at the midnight opening price today, and then you look at that with the London session, every single time it wanted to price lower, where was it pricing to? Below the midnight opening price. What does that mean? If it rejects, or if it trades below midnight and then it rejects that, it's an indication that smart money is getting into the market. Because why would it reject this specific level unless it's institutions and smart money buying it back up? So the algorithm drops it below the midnight opening price. Smart money's entering here. They're accumulating their positions. This accumulation is where they'll either be distributing them or hedging them. Then it drops again below. It distributes back higher, and then it trades below the market structure shift, aka the breaker block. So now you have a higher probability or a good read on your narrative in what price is going to do next. I entered at 427. Do you think it was too premature and should have waited for more confirmation? 427. Nah, that was a great entry. Great entry. Because I see what you're doing. It took out the... You can't see on this chart. Took out the low from yesterday's New York AM session. Like that. And then it displaces higher above this market structure shift, making this a breakaway gap. So that's a great entry. Well done, man. Okay, we're looking at our pre-market levels now, so we'll mark those out. Pre-market range is from 7 a.m. until 9:30. So you find the highest high and the lowest low in between that range, and that's what you want to mark out. Let's take a look at our regular trading hours chart. We're trading at 24,007.25. So we're not going to have a huge opening range gap today. We do also have, oh, that's the wrong one. $10 a.m. high impact news. So does that mean you're not trading until 10 a.m.? If you're trading the silver bullet model, then you want to refrain from being in at 10 a.m. But if you're trading something like the 2025 model, you can be in before 10 a.m. as long as you're nimble and as long as the volatility that you want there to be is already there. Because you have to be very careful in observing if price ends up getting held in a consolidation, because with 10 a.m. high impact news, you'll often see some time distortion. So in a day like this, you can treat 9:30 as high impact news that you want to get in on, post 9:30, and then 10 a.m. in between that half an hour window, you can do some trading in there. But if you're doing the silver bullet, you shouldn't be doing that. That's just for market open models. Okay, so we have the London low. I don't expect us to trade back into the London low. And then if we go to our 4-hour chart, I mentioned in Discord this morning, I want to see us trade into all-time highs. Okay, and then we'll look at our 8:30 opening price. Those equal lows between 709 and 720 got me thinking we're going lower. 709, 720. Oh, I'm blind. Yeah, I had it on the wrong one. Yeah, if I was to guess, I'd say it probably takes a pre-market high, low resistance liquidity, reverts into this pre-market low, and then between that and then post 10 a.m., you get a silver bullet set up into all-time highs. Is the 8:30 open really important if we do not have news? I believe that you should have it on regardless. It's just going to be more significant when you have news. So yeah, I would say have it on. Especially if you're moving around quite well in the pre-market session. It means you're just behaving algorithmically. It should give you more algorithmic price delivery. So whatever you're expecting, say you're expecting a move higher or lower, in that situation you can look at potentially getting 8:30 discount pricing or both discount pricing. So 8:30 open and the midnight open. If you're below both of those, it's a deep discount. If you're above both of those, it's a deep premium. Are we just going to run into all-time highs? In all-time highs, I don't like to sell. I just like to buy. So you should have bullish bias generally in all-time highs because you can't be certain that it's going to start trading into sell-side objectives. Sometimes it'll just keep going higher and higher and higher and higher. You can't time that reversal when you're lacking those liquidity pools. So you kind of have to wait, or you let, say we trade into all-time highs and then we trade lower, like this. And we have a drawn liquidity down there. Am I going to sell that? I'm not. I'm going to wait for either a change of state or some kind of idea that enforces a bullish narrative, and then I want it back towards either the new all-time high or some kind of low-hanging fruit. With all-time highs, you just have to be... It's not that you have to be nimble, but it's that you have to restrict yourself from certain trading ideas. You can't really look for shorts very well, and yeah, that's why all-time high conditions kind of suck. 6 likes. Let's get some likes on the stream. Por favor. Did you go over the confirmation of entry at the implied dealing range? Yeah, I did at the start. We were basically using this as the implied dealing range's impulse swing point, basically where you started from. And then for my first entry, I was using these relatively equal highs as the terminus of that implied range. And then for my second entry, I was looking at these New York PM relatively equal highs. Okay, our opening range gap, really small today. Okay, let's take a quick look at the other assets. So YM dumped. That's decoupling. Yes. Okay. So as mentioned in previous lectures, if NQ is the stronger of the 3 assets, YM is usually going to be the weaker. So you can see they literally did polar opposites. NQ went quite up, YM just dumped. ES is always going to be something in the middle, so like that. Didn't dump quite as much, didn't rise up quite as much. So if Nasdaq is strong, YM is usually weak, and then ES is in between. I didn't see any fair value gap or order block at equilibrium of the dealing range right up to the chart. Was there one I missed? Yeah, probably because there was loads. That was a good one because it's right at the start of that price swing. But my entry wasn't based on an order block or fair value gap. I entered early because I didn't have time to set the chart, so I anticipated it sweeping the low. I thought it would probably go into that low in this order block, but I didn't even need to do that. So I entered early. And my second entry, that was based on it sweeping these 2 consolidation lows. Yeah. In a decoupled market, you're not looking for SMTs. So that is filter number 1. When Nasdaq is moving up and YM is moving down, you're not looking for SMTs. If it's like this, if it's just, Nasdaq creates a higher low and YM creates a lower low, that's an SMT. What I mean is, if one of them's dumping and the other one's rallying higher, then in that situation you're not looking for an SMT. Both of them seem to want to dump now. Okay, we just touched the consequent encroachment of our opening range gap. In a gap that's only 33 handles, taking that consequent encroachment level or trading towards it and filling it in, or just touching it, tapping it, is extremely likely in the first 30 minutes of trading after the 9:30 opening bell. So until 10 a.m. it's 9:30. 9:30 opens. If you have an opening range gap that's less than 120 handles, you have about a 70% chance of trading into the consequent encroachment level. Consequent encroachment is just the 0.5 on that fib. Okay, so bearish order block. A few streams ago, is that an order block at 9:30? Yeah. A few streams ago I said, oh wait, no, it wasn't a few streams ago. When was it? Whatever. Generally, when 9:30 takes the pre-market high, or 9:29 or 9:31, you have a very good chance of trading into the opposite end of the pre-market range. That information alone can be an entire model for you. So if you were not using the silver bullet, at 9:30 you sweep the pre-market high like we did here. We overshot it quite a lot, but then we traded back below it, we closed below it, we opened below it, we traded lower, below this bearish order block. And you know that the likelihood is we have a discount gap. We should be going and filling that in because it's a small gap. We also swept that pre-market high at 9:30. So you know the odds are in your favor that it should trade lower, fill in the gap, and then go into that pre-market low. That alone is enough of a model where you can take that 2 or 3 times a week if you're only looking at the Nasdaq. If you're looking at other markets as well, then 5 times a week, 6 times a week. Okay, so we took the pre-market low. We've swept it by the looks of it so far. It depends on how this candle goes. But we've just gone below the midnight opening price by 1 tick. You want to see this become a swing point now, because the draw for me here is all-time highs. And if you're looking at a silver bullet setup, you're looking for all-time highs. Or you're looking for sell side to get manipulated and then trade into all-time highs. Would you take that if you're bullish for the day? Take what? Take a buy right now? No. I would need more market structure shift, change step delivery, stuff like that. Everything we've gone through in terms of waiting for it to flip the market structure. So when there's a liquidity event, we trade through pre-market low. Where's the narrative? Are you looking at something that wants to reject that level? Is price looking to trade higher? All that narrative comes from this liquidity event. It comes from any high that's put in after that liquidity is taken. If this is a sweep or a run, the speed of the candles, the PD arrays that form, all of that builds into the story of what you're looking for in price. Now the sell once you sweep pre-market high. Oh, no, I wouldn't have taken it if I was looking at all-time highs, no. I mean generally. I don't want to be in sells when we're this close to all-time highs. Because you can. It's kind of trend trading, but you can. In my opinion, it's just easier for everyone if you... It's cringe, but yeah, trade with the trend. It's just easier to trade with the trend. So if you have an overall bullish bias for the day and you want to trade into all-time highs, and you know that we're not going to retrace too far down, where you're not going to get a huge run, then why would you sell? You just wait for the manipulation and trade the distribution higher. Trend is your friend, yeah. I hate that little one-liner, but it is kind of true. It's not so much about the trend, it's so much about the bias, in my opinion. So if you have enough in price action to determine that it's going to trade higher, then don't sell. You're just reducing your probabilities. I agree, it's choosy. Here we opened up at the opening range gap low. It's kind of nice. We are in a deep discount relative to the daily range. A bullish SMT below 8:30 opening price and midnight opening price, if you have a bullish bias, is a strong SMT. And that's something you have to write down. I filter my SMTs if I'm looking at something extremely like this. If we're below the 8:30 opening price and we're below midnight opening price, that is a deep discount for the daily range. If you get an SMT in a deep discount, you have a bullish drawn liquidity, and price is giving you indications that it wants to trade higher, like supporting displacement, market structure shifts, change states of delivery. It's showing you bullish order flow. Every down close candle supports price. That type of stuff, if you get an SMT below the midnight opening price and 8:30 opening price, it's a strong SMT. So let's go to ES. Let's go to the chart. That's an SMT. And it's below the 8:30 opening price and the midnight opening price. Does it need to be below 8:30 opening price and midnight opening price on both of the assets? No. Just on the one that you're looking at. Could you quickly go over the difference between change state delivery and market structure shift? Yeah, sure. So any down close candle is a state of delivery to the sell side, and any up close candle is a state of delivery to the buy side. Say we trade below these 1, 2, 3, 4 up close candles now. These four candles is a one directional, one-sided move to the buy side. So from 9:39 here to 9:42, and maybe even 9:44 now, these candles are a move to the buy side. So that's a state of delivery to the buy side. Trading below that would be changing that state in delivery. Okay, that line is useless. Yeah, trading below that is a change state of delivery because you flipped the state of delivery from buy side to sell side. Now, it can't be a wick, it needs to be a body. So you want a candle body going through that. Otherwise, you may be looking at a rejection block. So this down close candle, that is a state of delivery to the sell side. We opened up, traded higher, traded lower, closed there. So the majority of the candle or the trade delivery in this 9:43 candle was sell side delivery because the majority of orders are taking place within the bodies of the candle. So trading above that is changing that state in delivery. And that is how you look at bullish order blocks and bearish order blocks. That is a bullish order block because it's a state of delivery to the sell side. You trade above it. When you go back into it, it's a good order block to buy on. So change in state of delivery and order blocks are heavily linked. And a market structure shift is a high or a low. So a swing point where you can frame the idea that there are trailing stop losses there. And then the algorithm takes that out, and if it shows you displacement, then you're likely to trade through it. So would you use this swing point as a market structure shift? No, because it's swept, we have a bullish bias. You only want to start looking for market structure shifts when you get a sweep of liquidity and you have a bullish bias if you want to go long. If you're looking at a sell, because you have a bearish bias, then you're not looking at a market structure shift to the buy side. So here there is no market structure shift until about there. So what would you use instead? You can use fair value gaps. You can use change in states of delivery, like that. Technically, every single candle here, where we trade through it, is a change in state of delivery. But we don't go by technically, we go by what's going to give us the best results. Okay, coming into bias. Why do I think it's going to go into all-time highs today? Okay, we're just going to have to deal with all those drawings. ES is trading at all-time highs right now, as we speak. And YM is also at all-time highs. Nasdaq isn't at all-time highs yet. So some people would say that's an SMT. I saw a lot of people last week saying, oh, it's an SMT divergence to the sell side, and it should reverse and trade lower. But I thought, because this is an all-time high, YM is at all-time high, and Nasdaq doesn't look bearish to me, I said, I don't think it's a bearish SMT. It's a Six Sister theory, or an SST. What is that? It's just when the asset that you're looking at that hasn't made the high is lagging behind. So a lot of people will describe an SMT to you incorrectly. They'll say an SMT is they'll say it's when it's lagging behind. An SMT is a breaking correlation. So if this is Nasdaq, and Nasdaq doesn't trade below this low, but YM does trade below that low, or ES, or whatever it is, then what you're looking at is an SMT. But if you have a bearish bias, are you going to just flip your entire bias because you got an opposing SMT? No, it's like getting a fair value gap. You wouldn't flip your entire bias if you're bullish and you trade into a sell sign imbalance like that. Are you going to flip your entire bias? Nope. I wouldn't. I'm going to say, okay, I want that to be inverted, or I want it to be disrespected. With the Six Sister theory, it's the assets lagging behind. So if this is ES, and ES has traded below this low, and Nasdaq hasn't done that yet. Remember, they're not moving completely symmetrical where they do everything at the exact same time. So not every single time, but a lot of times when you're looking at liquidity pools, ES will take it and then Nasdaq will take it, or Nasdaq will take it and then ES will take it. That's known as Six Sister theory, or a Six Sister. So that's why SMT is so easy to get tripped up on, because if you're looking at it in live time, you can see, like, when it's live trading and Nasdaq hasn't taken that low, but ES has, but then you think, okay, it must be an SMT. So you look at that as an SMT. But then a couple of minutes later, it just trades below the low anyway. That's because it wasn't a break in correlation, it was just lagging behind. It really is that simple. With the all-time highs, some people are saying it's an SMT. I'm disagreeing because nothing in Nasdaq on the higher time frame shows me bearishness. This is complete bullish order flow to me. Yeah. So I'm not going to flip my entire bias just because there's one SMT, no matter which asset it's made with. Generally, the best SMTs are going to come from Nasdaq and Q. Yes, that's going to be your best SMTs. Using YM, it is permissible. It's not like it's wrong, but it's less reliable. Why is it less reliable? Because YM is just less reliable as an indice. There's only 30 companies in it. They're not as strong as they used to be. Whereas Nasdaq's got 100 tech companies, ES is 500 of the biggest companies. They're much stronger in their readings. So NQ and ES are going to give you the better SMTs because they're closely correlated, whereas YM is slightly less correlated. But again, you can still use YM, it's just you put less emphasis on it. My NQU 2025 chart is delayed more than yours for some reason. Have you purchased market data? If you don't have market data, it'll be delayed by 10 minutes. But maybe mine is, I think on the free plan, if you don't have TradingView Premium, it updates like every 10 seconds or something, or every 15 seconds. But if you have the premium plan, then it updates just instantly, as fast as your Wi-Fi is. Yeah, if you don't have premium, it'll be a little bit slower. Okay, applying dealing ranges. Your highest probability SMTs are going to come in the discount. So if you're bullish and you get an SMT in premium, that's fine. But what's better is when you get it in discount. So we're in discount of the daily range because we're below midnight opening price and we're below 8:30 open. So that is a deep discount relative to those two true opens, and those are powerful true opens. Then if you look at the parent price movement that we're trading within, which is from the London low to the New York AM current high from the 9:30 candle, that there is the dealing range that we're working within, because it took out sell side, took out sell side, and it also took out buy side. So that's what allows us to use this as a dealing range. Trading into the discount of that, that's where you're going to get higher probability longs. It's also where you're going to get higher probability SMTs. So this is a strong SMT because it's between ES, that's tick number 1. It's during a time of volatility, 9:30. And it's below the midnight opening price and the 8:30 opening price, and it's in discount the dealing range. So strong SMT. Say you're on a daily chart and you're not looking at true opens, you're looking at a dealing range and you get an SMT within discount of your dealing range and you have a bullish draw on liquidity. Even if your bias is to trade lower first, you can use that SMT for a retracement on the daily chart. And a daily chart retracement is an entire candle, or even if it's the first part of the candle and then trades lower, leaving that higher time frame wick there. If you're using that on a daily chart and then you come down into your intraday chart, like the 15-minute, the 5-minute, the 1-minute, even though it's not a strong probability SMT, because it doesn't align with your narrative and your bias, the very idea that it has something above that it could trade towards, and it's happened on a higher time frame, means you can get some form of short-term retracement on a lower time frame chart, like the 1-minute, the 5-minute, the 15-minute, something intraday, where you can get a small scalp. So say this was, actually I would need like a chart example. I'll try putting it in later. But yeah, on a high time frame chart, you can drop a time frame, or 2 time frames, or 3 time frames, and you can get, even if it's not a good high probability SMT, but it's still in, some kind of discount of a dealing range, or it's below some kind of opening price, like the monthly opening price, like the weekly opening price, then you can get a short-term little retracement from the SMT, and then the SMT will still be disrespected, but that retracement is enough for you to get a trade on the lower time frames. Does that make sense? Oh, I don't have premium. Does that put me at a disadvantage at all? Not really, to be honest. Not really. Do you trade silver bullet usually? If yes, what sort of confirmation are you looking for as start of silver bullet, previous day high, previous week high, session high, low? What do you told you're teaching, please, such as instant delivery? Okay, Model, go through the silver bullet mentorship playlist, because it seems like you haven't been through it. If you just go through it all, I've taught everything silver bullet regarding silver bullet. I do trade the silver bullet. It's not my only model. It's not my favorite model, but it is one of them. It's probably like top 3. It's pretty easy to trade. I taught it really in depth. So if you just go through the playlist, there's 13 lectures now. There's going to be one coming out tomorrow as well. So yeah, you can go through that. It's on my YouTube channel. It's free. It's all for free. SMT, thanks. Do you mind explaining which trade plan do you use? Usually 2022, 2025 pre-market. I use a lot of different models, so I use 2025 sometimes, I use 2022, I use optimal trade entry, I use swing grading, I use market maker models, I use the ATM model, the pre-market model. It just depends what time I want to be at the chart, what time I'm free, or like what time I feel like being there. Sometimes I just don't want to trade, so I just won't. But yeah, would you use the 944 candle as the first represented fair value gap? Let's check. Yeah, I guess you could use that. Let's see. It's not. No, I wouldn't use that. I would use this one that's forming right now. Because it's breaking away from the range. Or from the chop. We pretty much called this entire move right at the start of the stream. Or at the start of the open. But you can see that the 930 rally, a lot of times it's going to be a Judas swing against the daily range. So if you were against the underlying draw, so all-time high is my underlying draw right now. ES has already reached it, YM has already reached it. I think NASDAQ, it's the SMT pair, it's a 6 sister pair. So I want NASDAQ trading into the all-time high. That's what my higher time frame bias is. So with that, when you're looking for manipulation lower and you get it, you're expecting it to happen right at the open. So when you manipulate lower and then you have every single factor in alignment, you can have so much more confidence in a buy trade if you have the extra confluence with the SMT. Because in SMT, it's not necessary to trade with. You don't need it for the silver bullet, but it gives you that little extra boost over the edge because now you know it's going to deliver with more speed. If your SMT is delivering really slowly, you probably picked a wrong one or it's just not going to perform. With an SMT, you're going to see quick price action. So right here, we got, although it was back and forth with the wicks, it still traded higher pretty fast. That's what you want to see out of an SMT. You want to see that little fuel. That's what it is. It's fueling price. That breaking correlation between the two assets. Because this, at that point, when the SMT forms, below midnight opening price, below 8:30 opening price, below or in discount of our underlying dealing range, what is that? That's an oversold market condition. You don't need an RSI indicator to tell you that. You don't need, Larry Williams' divergence formula. You can just use stuff like this. You know it's oversold. If you have that bullish narrative, then isn't that the point you want to buy at? Any questions regarding SMT? 10 a.m. news. Even though you wouldn't have traded it because it's a news candle, it did drop into that order block and at the consequent encroachment level. Spool point. I had the same trade as ICT in the morning, which was really nice. So this started off as a liquidity void because the news candle opened up there, traded lower, and it closed back inside of it. But this little portion where there's a body, or where there's no body, is unmitigated. So we'll probably get a closure past that, and then you want to treat that as something that's suspect to go higher. So basically, a down close candle that closes above or past this little tiny portion of that void that was formed from the news candle, and then up close candles again. Okay, guess not. That's a good sign though, because it means that it's refusing to do that. It's bullish. It should get more speed now. Do you use the 930 open as a reference point? Yeah, so the opening range gap incorporates the 930 open. A lot of people think you need to use them both. It is the 930 open because you draw it from 414, whoops, 414 of the previous day into 930 of the current day. So in this case, it's the high of the opening range gap. It'll either be the high or the low. That is the 930 opening price. This. Okay, change state of delivery maybe. No, not yet. So you want this to trade above that down close candle, which flips the state of delivery from sell side to buy side, and then this will be treated as a bullish order block. But this is bullish order flow already. Down close candles are supporting price to go higher, so down close candles supporting price. This candle is kind of it's not irrelevant, but it's kind of dodgy because it's the news candle, so you want to look out for that. I know people are going to be going crazy over this as a data low. Just because you have a data low or a data high doesn't mean you flip your bias. So if you at 10 a.m. or wick down and you trade back up, are you assuming automatically that's going to go into that? No. You'd still go with your narrative. So I'll mark it out, but that doesn't mean I want it to go there. That's just because I want people to know that I've acknowledged it. Okay, this is well weird as I'm seeing price in the charts through your stream before it's even on mine. I have ultra low latency on, so it's like the second I talk, like half a second later it'll be on your screen. I think. I don't know what the delay actually is, but it says ultra low. Do you consider open SMT like if one pep goes below? No, I don't consider that. I know it's a quarterly theory thing, but I don't bother using it. I tested it one time for a couple hours, and I was like, I don't like it. I have gone through all of Day's mentorship and quarterly theory, and I like some of it, but the stacking of the true opens, although I think that's good, I don't like the opens used for SMT. But that's just me. Precision swing points are fine. Like, I don't mind precision swing points. I haven't really trained my eye to spot them a lot though. I can spot SMT really easily, but precision swing points, no, I don't really use them. The midnight open and 8:30 are used as an overbought, oversold for the whole day, or just a new game session. Like now it would be overbought, but we don't care because of bias. Yeah, like it's for the daily range, but if you just think of like realistically on the daily chart where you have the midnight open and the 8:30 open, even though it's in an overbought condition, it still has to trade higher. Like if you're getting a higher volatility day, it's gonna trade past those levels and way past those levels. So at a certain point, are you disregarding it? No, but like here, it manipulated, it went into the oversold condition, and then you expect the expansion. When you're expecting the expansion, you can allow for retracements past that opening price, but you don't want it to run against that. You want it to keep expanding in your ideal price direction, narrative, whatever. Do you integrate quarterly shifts? Yeah, but it doesn't affect the silver bullet that much. If looking at a silver bullet after 10 a.m., would you consider sweeping the relatively equal lows before the fair value gap? If we then create a market structure shift. Wait, let me read that again. If looking at a silver bullet after 10 a.m., would you consider sweeping the relatively equal lows before the fair value gap? These ones? I assume you mean these ones. Would I consider going long if it trades below that and then goes back up over the market structure shift? For swing trading? Oh yeah, I use it for one shot, one kill in Forex, and I use it for my daily power of 3 or buy or sell days. But really it's for just determining a high time frame order flow. So seasonal tendencies as well, I'll use those. Each month has a different way of trading. Yeah. It's not like a huge part of your analysis. You literally do it once a quarter. Seasonal tendencies you do once a month. It's so easy. You just look at the chart and that's it. Which openings can we use in the PM? Are there any significant opening times in the PM to use? Yeah, you use the 9:30 open. Use the 8:30 open. The midnight opening price, it depends what day you're looking at. So if you're looking at an expansion day, where it's the classic buy day profile, you wouldn't use the midnight opening price at all. But if it's a consolidation day, then you can, yeah. But for the PM, you can use the 1:30 opening price. Well, it's not the open of a market, but it's the opening of the Neo PM kill zone, where that opening range begins. Some people like to use lunch as an opening price. I've never found any good results with it, to be honest. There are occasions it worked, but I think from my backtesting data, I didn't have any good evidence supporting that. 8:30 open, 9:30 open, and 1:30 open. Those are pretty good. And the new day opening gap, so the 6 p.m. open. Yeah. Let's get some likes. Let's trade into all-time high, please. That would be dandy. That would be my first objective, past all-time high. Something you can try is looking at the daily range through the lens of just the kill zones. So if I take, or if I go to another chart, and I'm just exclusively looking at the kill zones now, I'll look at things like the midpoints. I'll look at like the inefficiencies within them. So this, how do we trade back into it for later kill zones? So for this one, we just touch into the 5-minute SIBI, but then it becomes an inversion fair value gap after London closes. Then in the we trade back into it, and it's also at equilibrium of the London range. So that's just something you can try for yourself. Oops. Okay, that's a deeper retracement than I would have liked. I would have liked something to just pop up from there. So, although it's not invalid, and you could see this is pricing below the 830 open for smart money pricing. The ideal scenario here would have just been to trade back up into the all-time highs without any real resistance. But then relatively equal highs. We make the high at the start of the session, we trade back up into it, and then we get a severe displacement lower. Have you flipped your bias? I haven't flipped mine. I'm still bullish. I guess it probably will take the day a little, but we'll see. This is where if I didn't get into a trade at the start of the session, or around here, and I wanted longs, I think I said this in a recent stream as well, if you just fall short of a strong drawn liquidity, what was a strong drawn liquidity here? All-time highs, this high, we fell short of it, we displaced lower away from it, fast. That's baiting people. That's getting people to chase price. So the second you either trade into an old inefficiency or past an old low, and then you start seeing signs of bullish market structure again, you can see this displacement lower as a Judas swing that just tricked traders into getting into position, and then it goes against that and then goes into your original draw anyways. So this could be a setup if you don't take to the silver bullet, but you do take something like this where it trades away from a pretend. It just misses your draw on liquidity, it trades away from it with displacement. Basically, whatever this is, when it trades away from it, it has to be something that looks like it's going to be getting traders offside. So if you have a strong bullish bias and you fall short of the draw, the displacement lower has to be getting people into sells. And then when it takes a low or an inefficiency or an order block, that's when you can start looking for buys into your draw. That's for late entries. I learned that from swing grading and I applied it to this, but it's not the swing grading concept, it's just the idea stemmed from swing grading. For drawing data highs or lows, to be used the first 1 minute after the release only. Nah, so the swing point that's created by the data highs or lows. So this one, that would have been it, and then it would have been this one. Yesterday it was 831, I think, for the swing point, or 832. It created a high, and then there was a high next to it, but it wasn't through a swing point, it was just through a candle high. So I used that because that's where the one directional move from the news data release happened. That's it. It's really simple. Okay, so we're trading into that order block, and we haven't inverted this gap, which is good. Let's see what it does. Rejecting hard off that high now. Quarter trade entry. Yeah. Yeah. Nearly. I put that at 6-2. Oh no. Gets further away. Stupid. ES took the data low. Really. Yeah, that's an SMT as well. And you're in the discount of the New York AM range on both pairs. Let's just do this. See that? Okay, so on the 5-minute chart, that volume imbalance has one down close candle going past it. Generally, you want two candles that are opposing to go past it. So a down close candle is one side, and then this volume imbalance isn't done until you get an up close candle through it. So if we close above there on the 5-minute chart, then you could see it. Obviously, we're not going to take it off and completely disregard it, but this is a draw until there's both sided candles on it. So if we've traded below it and we've closed past it, then it's a buy side draw. And if you close above it now, rather than being a draw, it would be something that you could use as support. Yeah. Generally, they can still be used as support, even if nothing is closed inside of it, but they can also be used as a draw. If you've had candles closing past on both ways, then you wouldn't use it as a draw. You would just use it as an area for support or a point of reference that the algorithm's going to use to deliver higher or lower prices. Who teaches you that for free? What's your next lecture going to be about V? It's going to be psychology. It's going to be a psychology one. So I'm going to be talking about a little bit about trade management, mastering the model, and you as a trader using the model. I designed an amazing little thumbnail for it as well. I'll show you a little preview. The stream gets a preview. I think it looks really good. Here's a thumbnail, Clinton and his Lambo. You should see Clinton's car. It's not a Lambo, it's got Bugatti. Bugatti boy. Wasn't the first presented fair value gap form for 945. Yeah, you could use the 944 candle, but I don't like that one. It's too small. I wouldn't use that in my normal trading. So with first presented fair value gaps, the element of nuance and discretion does come in because it's about what you would use in your normal trading. So I don't look at this as a fair value gap generally, although it's an inefficiency. Unless it's on the daily chart, then it will have some kind of reaction on the lower time frames. But if it's on a 1 minute, I'm never using that, ever. Something like this, that's the real obvious nice one. Okay, all-time highs taken. Another call out. And we called everything perfectly. Pre-market high, reverts into pre-market low. The London low shouldn't be traded into. Price below the 8:30 open and the midnight open. Traded back above, the news candle came in. We said we wouldn't want to see that taken out because it's against our narrative. Get bullish SMT, first presented fair value gap, traded into all-time high. And that little setup I told you about earlier, where you basically form a Judas swing right before drawing liquidity. That's a good long. So, who tells you this stuff for free? Come on. Come on. Oh, I'm so good at trading. Thank you, thank you. Let's get some likes on the stream. Did you see the thumbnail number? Look at that art. That's me. The one thing I did mess up though is this is supposed to be a replication of the silver bullet. But a gun and a bullet don't look good in the picture, so I put in a bow and an arrow. And this is meant to be silver, but it's kind of gold. So that's a bit messed up. Oh well. The concept applies. Can't thank you enough. Well predicted as usual. W stream. Thank you, thank you. I appreciate all of you. And look at the opening range gap delivery. But this is the completed model. This is how you use a silver bullet. We're using pretty much every element that I've taught so far except for the new day opening gap because I wanted to save that for the price action workshop tomorrow. Because I'm pretty sure it's been used there. It was a really good one. And in the London silver bullet, tomorrow we're going to be doing the price action workshop. Yeah, we're going to go through this. So if you want to study that today, hint, market maker models, and fulcrums. It's not only going to be that, there's going to be a lot of stuff. It'll probably be like an hour and a half stream. But everything I've taught so far has been pretty much incorporated. We used SMT today, dealing ranges, the pre-market range, opening range gap, first presentation gaps, discount pricing, deep discount pricing. What else have I taught? Liquidity events, market structure shifts, change in system delivery. So this is how I want everyone to be doing this if they're going to be using the silver bullet model. I understand not all of you are here for the silver bullet, you're just here for the tape reading, which is fine. But if you're here to learn the silver bullet, this, I'm not saying you should be doing this instantly. You're not going to get it right like this every single time, and you're not going to have everything on your chart. But this is what you'll eventually evolve into. But you can't demand it straight away. So everything I just predicted here, are you going to go out there tomorrow or on Monday and get that instantly? No, because this takes time. If you want to be able to do all this stuff, it comes from tape reading, it comes from back testing, it comes from forward testing on the demo, but you can't start with forward testing and stuff. Start with the tape reading aspect, the back testing aspect. Don't demand perfection instantly, because I don't get perfection, ICT doesn't get perfection, you don't get perfection, nobody does that. If you get it wrong, journal. I always say journal, but it is just the best resource in training. A journal can teach you way more than I can teach you. I'm confused about the silver bullet here. Would you have cast a sweep at the pre-market then enter the first minute fair value gap? Oh, the silver bullet was easy. Yeah, look, we sweep the low of the pre-market low. It doesn't need to happen in the 10 a.m. window. It doesn't need to happen there. Your entry can be in the 10 a.m. window, your entry can be in the 9:50 window. As long as the setup forms and something between 10 and 11 a.m., 9:50 and 11 a.m. is the silver bullet, so the fair value gap, the market structure shift, the order block, whatever the hell you're going to use. As long as that forms within the time window, it's fine. So we swept the low, we trade higher. If you were strictly using market structure shifts, it would have been that, and an entry on the first month fair value gap. If you are a bit more flexible and you allow yourself to use changes in state of delivery, you could have used that as a change in state. You could have used that, you could have used that. Depends on what you prefer, what you take an affinity to. You could have treated this order block as a change in state as well, and entered on that. Look at this beautiful price level. So the silver bullet here is right there. I don't want to enter the fair value gap at 10 a.m. Oh yeah, fair enough. Fair enough. But even on that news, say that I want to enter news, which is fine. You don't need to enter before news. I probably would have today, because I'm just like that. But when we fell short of our draw, and then we got that displacement lower, and I said, treat that as a Judas swing. If you're buying and you have that bullish draw with the all-time highs, then you can treat this as a Judas swing and buy that. If that makes sense. Basically what I explained like at 10:14, so that was 15 minutes ago. If you reverse the stream about 16-17 minutes, you'll find the explanation for this. So say you didn't want to enter because you had the 10 a.m. news, which is fine. Yeah, that's fine. Then you could have entered there as a late entry. Even with that data low, like I bet a lot of people probably try to sell into this data low. When it retraced into that SIBI, we must have got someone selling into that data low. But it was against the narrative. This high, this low. That's my first draw. Oh yeah, this is the one I mentioned earlier. If you remember early in the stream, with this retracement, I drew the fulcrum out. That's what we're looking for. I did say that, didn't I? Pretty sure I did. Unless my memory is deceiving me. Okay, that's... okay, wait. Last little thing. That's true, so could you explain why entering at the 24,051 would have been bad? Could I have predicted the Judas swing? Could order block? Oh, or 24,051 order block. This order block could have entered there. I think if you're on the micro art, prices are going to be a bit different, so just tell me the time of the candle you're talking about and then I'll look at it. But yeah, you could have entered on that. You could have entered on this being an inversion fair value gap. Could have entered on the first presented fair value gap with the SMT. Lots of entries. $10.08 order block. Okay. $10.08. What? This is a bearish order block. You wouldn't use that for buys. A bullish order block is a down close candle, and a bearish order block is up close candles. Unless you mean 10-10, but even that isn't really the order block. I don't know, maybe I misunderstood what you said. Unless you mean 10.06. Okay, yeah, put it in Discord. Okay, that's it. I'm gonna end the stream then because I'm hungry. But you know, this is the final way of trading the silver bullet. We're using so many more confluences here. If you approach every single trade with a silver bullet like this, or how we did in London, you can ignore the swing grading if you didn't understand that. You don't want to look into that. If the silver bullet is your model, stick to it, and every single thing I've taught is confluence. You can use it all. You can pick which one you want. You can use just SMT. You can use just dealing ranges. You can use just the opening range gap. But everything I've taught you for free, if you combine it, your charts will look like this. Your setups will look like this. Every single trade you take, well, not all of them, but generally you want to be annotating most of the things that I've taught in this. Not all of them, because you'll have correct charts. You can write stuff down on the side and stuff like new day opening gaps. I don't have it on my chart today. Even though it was used in London, I don't have it on my chart today. Just because I thought it's too ugly. I want it on the chart. But what I'm saying is, as you evolve, as you keep trading the silver bullet, as you keep going through the mentorship, you'll understand every single little aspect that we've taught. So the SMTs, the dealing ranges, the opening range gaps, discount pricing, the midnight opening pricing, the 8:30 open, identifying the manipulation side and the draw, the liquidity events, the market structure shifts. If you haven't seen the market structure shift video, you need to see both of those. And then tomorrow we're going to be doing a price action silver bullet price action workshop. It'll be streamed on YouTube as well. It'll be just like the implied dealing ranges stream, but without any chart reviews. So it'll just be me going through examples and explaining a lot more things, dropping some gems, incorporating a little bit of market maker models, stuff like that. So that's like the cherry on top. And then the last video, which will probably be Sunday, will be a psychology talk. But it's not like deep, it's just trade management, how you should approach the model, how you should be incorporating it, which one you should use, if it's even right for you. A lot of stuff. Yeah, that's the stream. I'm going to end it now. I'll see you all later in Discord. Like the stream as well, because we don't have that many likes. Oh wait, would you consider doing pre-recorded and sped up silver bullet price drill videos? Maybe. I don't know. Maybe not. It's too time consuming. Would you use the projection fib to try to predict where the all-time high will get to? I wouldn't use it to try and pick the very top, but I would use it to predict the lines portion of the MIV. Probably not in the 1 minute chart though. You probably want to use something more related to the daily range. But yeah, see you everyone. See you.